Hi. Let's learn about floating interest rates. A floating interest rate is an interest rate that changes periodically. It moves up and down, or floats, reflecting economic or financial market conditions. It's also known as an adjustable or variable interest rate because it can vary over the term of a debt obligation. Floating interest rates are commonly used for consumer loans, such as mortgages, car loans, and credit cards. A floating interest rate rises or falls with the rest of the market or along with a benchmark interest rate, such as LIBOR, the federal funds rate, or the prime rate. Banks and financial institutions charge a spread over this benchmark rate for consumer loans and other debt, which will depend on factors such as the type of asset and the consumer's credit rating. Floating interest rates are especially common with credit cards and mortgages. Home loans that carry floating rates are known as adjustable-rate mortgages. ARMs have rates that adjust based on a preset margin and a major mortgage index such as LIBOR. Most credit cards also charge floating or variable interest rates on unpaid balances, which vary with the market conditions. A floating interest rate contrasts with a fixed interest rate, where the rate is constant and doesn't change. Residential mortgages can be obtained with either fixed or floating interest rates. With fixed interest rates, the mortgage interest rate is constant for the duration of the mortgage agreement. In contrast, with floating rates, the mortgage interest rates change periodically with the market. For example, Herbert and Amanda take out a 7-of-1 ARM for their $500,000, 30-year mortgage, meaning that their loan's interest rate is fixed for 7 years and then switches to a floating interest rate, which changes once a year. Their interest rate rises or falls with the LIBOR throughout the term of the loan. While a floating interest rate may save you money, it can make your financial planning and budgeting difficult because it changes, and you may need to spend more money if it rises. A fixed interest rate provides greater security and allows for confident planning. The choice between the two depends on your financial situation and your outlook on interest rates or the economy. A floating rate is a certain base rate tied to a benchmark rate, plus a margin above that base. For example, if a debt instrument has a floating rate tied to the LIBOR plus a 6% margin, then the floating rate is 12%. Yes, the majority of credit cards have floating rates, which fluctuate according to the prime rate plus a certain percentage. For example, if the prime rate is 8% and the added amount is 12%, then the credit card rate is 20%. A floating interest rate changes periodically based on the benchmark rate to which it's pegged. If the benchmark rate increases, the floating interest rate increases and vice versa. This risk of higher borrowing costs is the floating interest rate's primary disadvantage for borrowers. Here are 5 key takeaways. 1. A floating interest rate changes periodically, as opposed to a fixed interest rate. 2. Floating rates are used by credit card companies and commonly seen with mortgages. 3. Floating rates reflect the market, follow an index, or track another benchmark interest rate. 4. Floating rates are also called variable rates. 5. They're considered riskier than fixed rates. Hope this would help. Thanks for watching.